Hello students, this is Professor Kinnariben. The lecture is for Semester 1 English Medium students. The subject is Accountancy 1, compulsory subject. The chapter name is Consignment Account. The consignment account is already started by me. In last lecture, you had studied what do you mean by the consignment, what are the different transactions in consignment business, the respective journal entries for these transactions of consignment business, and what are different accounts are to be opened in books of consignor as well as in books of consignee. Now, in continuation of previous lecture, we are going to study some of the important concepts of consignment business or consignment account. The first concept is cost price and invoice price. It may possible that consignor sends the goods on consignment business to consignee at a price which is higher than the cost price. The price which is higher than the cost price is invoice price. As the name suggested, the price written on invoice is invoice price. Here invoice we are talking about for consignment business. The invoice written down by consignor to its consignee. It is invoice price. So we can say the cost price is a price at which product service is purchased as well as manufactured by the consignor. This cost price is also includes particular purchase expenses as well as manufacturing expenses. For an example, carriage inward, octroi, those are the expenses which are specifically incurred for a purchase. So, in the cost price, purchase price as well as some of the expenses is also counted. While invoice price is the price at which consignor sends goods to the consignor and it is higher than the cost price. The difference between the cost price and invoice price is profit. This profit is added by the consignor. It is not actually earned by the consignor because sales is not done by the consignee. Fine. So, this is unrealized profit. This is the imaginary profit which had been added by the consignor to cost price so that consignee will not have idea about cost price of the goods and products. There are so many reasons why consignor send his goods at an invoice price. One of the assumption is that consignee will not have any idea about the cost price and there will be no malfunctioning and fraud in the consignment business. So, we can say invoice price is equal to cost price plus profit. One thing. Second thing, this profit is unrealized profit. It is imaginary profit. The profit is not earned. The purpose of this profit into the added into the cost price is only that consignee will not have any idea about the cost price or a actual price. Now, how you will give accounting treatment for this cost price and invoice price? Understand one thing. If in the sum there is an invoice price, you must give journal entries with the effect of invoice price. That means whenever you are going to post your journal entries for consignment business or transactions, those entries must be with invoice price. the transactions related goods must be posted at invoice price. However, this invoice price consists the unrealized profit, so respective adjustment entries with a profit amount must be recorded. That means if you debit any amount with an invoice price, the added profit must be credited. So at the end, the original cost price is debited. Suppose the invoice price is rupees 100 and profit is 20. So the actual price is 80. Now you write down on the debit side that you sent goods of worth of rupees 100 on consignment business. Now 20 rupees must be credited with a reverse entry. So at the end of the accounting treatment, 100 is debited, 20 is credited. So at the end, 80, which is actual cost price, is automatically debited. So one thing, you give journal entries if invoice price is given at invoice price, but respective reverse entry must be given with a profit figure in goods related transactions. So here I write down what are the transactions. 3 transactions are there: when goods sent to the consignment, when goods returned by the consignee, and consignment stock. When goods sent to the consignment, so consignment account should be debited, because whenever you are going to purchase, you debit the trading account. So here there is an inflow of goods. So consignment goods sent to the consignment account debited. However, the reverse entry is consignment account debited to goods sent to the consignment account. Now when goods returned from the consignment account, so the original entry is goods sent to the consignment account debited to consignment account, and adjustment entry with a profit figure is consignment account debited to goods sent to the consignment account. For the same consignment stock, at the end of the consignment business, you valued your stock. If stock valued at invoice price, you write down on the credit side of the consignment account, and consignment stock account should be debited. So the original entry is closing stock account or a consignment closing stock account debited to consignment account, and consignment account debited to consignment stock account is a reverse entry. So these 3 transactions must be recorded at invoice price if invoice price is given, and in respect to this 3 transaction, loading entry or adjustment entry with a profit amount should be given in a reverse effect or in a reverse entry. Now practical problems related to the cost price. Now we are going to discuss the practical sum which are asking by the university papers. Generally, if cost price is given, then the profit percentage will be given on invoice price. That means if one price is given, the profit percentage is given on another price, and that price is not given. 2 methods are there to calculate to cost price or invoice price. Remember one thing, in university sum or in university paper, one of the price is given and another price is you have to find out with help of a profit percentage. If cost price is given, you are going to find out invoice price, and if invoice price is given, you are going to find out cost price. So how you will do this? So there are 2 popular methods. One method is a very traditional method. In that method, you assume rupees 100 a price which is not given. If invoice price is not given, then you are going to assume that therefore invoice price is equal to 100. And if cost price is not given, then you are going to assume therefore cost price is equal to rupees 100. Second thing you have to understand here is that which price is not given on that price profit percentage is given. That means suppose there is an invoice price you are going to find out, the profit percentage will be given on invoice price itself. For an example, I write down here the example. If cost price is rupees 80 and 20% profit is to be added in invoice price, then invoice price is to be assumed 100. Now here three things you have to understand. First, cost price is given, it is 80. Second thing, invoice price you are going to find out. So which price you are going to find out, it must be assumed rupees 100. Third thing, a price which is to be find out, for that profit percentage is given. In our example, read the first line, and 20% profit is to be added on invoice price. So you are not going to add 20% of rupees 80 in rupees 80. Or in other words, you are not take profit as a 20% of rupees 80, because this 20% is given on invoice price and invoice price is not given. So you have to assume that invoice price is rupees 100. Make 20% of rupees 100. So 100 ka 20% is equal to 20. Now 100 minus 20, 80 rupees is your cost price. So this is the old traditional method. It is time consuming method. The second method is table. You have to remember the percentage and vice versa effect on each price. Now suppose in sum the invoice price is there and profit percentage is given on cost price, you can convert the profit percentage on one price to another price. That means if you want profit percentage on invoice price, you have to see what are the profit percentage on cost price. If the invoice profit percentage on the invoice price is 10%, the same profit percentage for the cost price is 1 divided by 9. If profit percentage on invoice price is 16.23%, the same profit percentage on cost price is 20% or 1/5. If profit percentage on invoice price is 20%, the same percentage on cost price is 25% or 1/4. There is one tip I will give you to use this method very effectively. For an example, whatever the percentage is given, make those percentage in fraction form. Now 10%, you can read on the screen, there is a 10% on invoice price. So is equal to 1 divided by 10, we can say, if we make it a fraction. So 10% is equal to 10 upon 100. So 10 upon 100, if we are going to simplify 10 upon 100, it will be 1 upon 10. Now if we want to find out this percentage on cost price, you have to just deduct 1 from denominator. So here it is 1 divided by 10. So it will be 1 divided by 9 on cost price. Same is 16.23%. Fine. It is a 1/5 if you simplify this form. So 1/5 or 1/6, sorry, it is a 1/6. If you simplify 16.23%, it is a 1/6. Fine. So 1/6 on 1 upon 6 on invoice price, it must be 1 upon 5 on cost price. So if you want to find out profit percentage from invoice price to cost price, you have to deduct 1 from the denominator of a fraction. And if you want to find out profit percentage from the cost price to the invoice price, you have to add 1 in the denominator of the fraction. The same for the 20%. If the invoice price is profit percentage on invoice price is 20%, is equal to 1 divided by 5. So on the cost it will be 1 divided by 4. Or if it is a 1 divided by 4 or 25% on invoice price, it will be 1 divided by 3 on a cost price. So these two methods are very popular. I suggest follow the second method, because this concept is very important. This concept we will follow in next two chapters, like branch account and joint venture. This concept you will have to understand till semester 6, because this concept more or less we are going to use in one or another chapter. So this is the most important concept. And understand one thing, if you remember this table with logically logic or understanding, there will be no any errors. Now another important concept of consignment is loss. Fine. Loss of goods sent on consignment business. It is possible that some of the goods may damaged during the transit if consignors sent those goods on the consignment via different modes of transport, like air or railway or via marine. It may be possible that some of the goods may damage. So this damaged goods or a loss of this damaged goods are bifurcated in two types. One is a normal loss and another one is an abnormal loss. Normal loss is uncontrollable. It cannot be controlled by manually. For an example, evaporation or any other unavoidable causes. And abnormal loss are occurred due to the manual error, for an fire, theft or any other avoidable causes. Second thing, normal loss is recurring. That means it will happen in natural course of action. Fine. Or it will going to happen whenever you are going to send the goods. If you send some of the goods, for an example, if you send some of the liters of a petrol, it may possible that some of the quantum of these petrol may be evaporated in transit, and it will happen whenever you are going to send the petrol or any other liquid in nature of evaporating. So it is a natural. You have to assume that it will happen. Well, abnormal loss is not recurring in nature. They are non-recurring. They will happen with an abnormal cause. Fine. So how will you give accounting treatment for these two types of loss in consignment business? First is a normal loss. For normal loss, there is a no accounting entry for loss is given. However, quantity of normal loss is to be considered while evaluating closing stock. You have to deduct quantity of goods which are damaged or which are destroyed due to normal loss to find out the sellable quantity. Fine. And those sellable quantity will be using to evaluate your closing stock. Understand one thing, there is a no journal entry, only quantity of normal loss goods must be considered. Second one is an abnormal loss. It is most IMP concept of this chapter. In 14 mark sum, there is I am 100% sure one of the adjustment is related to abnormal loss due to fire or due to theft. Now, abnormal loss is not in nature of recurring loss. The following accounting treatment is given. You have to find out total figure of abnormal loss. For that, number of units product multiplied by cost price is equal to, you have to find out the total loss at a cost price. So, number of units or a product multiplied by cost price per unit. Now, in this figure, you have to add two proportionate expenses of consignor as well as consignee, because we already learned that cost price also include the expenses made for the purchase or manufacture. So, proportionate expense of consignor, that is unit, you have to add it, and proportionate expenses of consignee you have to add it. So, first is proportionate expense of consignor. You are going to find out this figure with help of this equation, formula or equation. In numerator there is a unit lost. In denominator it is unit sent multiplied by expense of consignor. The same proportionate expense of consignee, unit lost in denominator or divided by unit sent multiplied by expenses of consignee. While by adding this two figure you can find out total abnormal loss. One thing you have to understand, while taking the expenses of consignee, the selling expenses or expenses those are in nature of recurring, you are not going to consider. You only consider those expenses of consignee which are specifically for receiving of the goods, like go down rent or freight or octroi, etc. We will understand this point more while we calculate the practical sum. So total, there is once you find out the total abnormal loss by adding these two proportionate expenses of consignor and consignee, further the claim, if the insurance is taken, if claim is accepted by the company, the amount of claim is deducted from the total abnormal loss, and net abnormal loss you are going to find out. The amount which is accepted as a claim from the total abnormal loss is debited to insurance company account, and the amount which is treated as net abnormal loss is to be transferred to profit and loss account or a general profit and loss account. One thing you must remember here, that loss is always valued at a cost price. If invoice price is given, then and then you will not consider loss, or you will not calculate abnormal loss with an invoice price, but you only take cost price into consideration while calculating abnormal loss. Here, for particular this adjustment, you ignore the invoice price. Fine. Now, next concept is valuation of a closing stock. At the end of the consignment business, closing stock must be valued at a cost price or invoice price. If invoice price is given, the closing stock must be evaluated at an invoice price. In the same manner, when we calculate the abnormal loss, we calculate the total closing stock. First, number of units in closing stock multiplied by invoice price. In this figure, you are going to add proportionate expenses of consignor and consignee. The same formula is given. On the numerator, number of units in closing stock is taken, and in denominator, total units, or if there is a normal loss, total sellable units is to be taken multiplied by consignor or consignee's expense. Fine. Here you also take those expenses of consignee which are in non-recurring nature, or which are not for selling purpose or a selling expenses. So you are going to find out total value of closing stock at an invoice price by adding these two proportionate expenses into invoice price. In same manner, the stock reserve entry you have to given. Fine. Stock reserve entry is for unrealized profit included in closing stock, because this closing stock is valued at an invoice price. So whatever the unrealized profit is there in closing stock, it must be debited. So how you are going to find out? Stock reserve is equal to number of units in closing stock multiplied by profit loaded per unit. Here abnormal loss is valued at closing stock must be valued at a invoice price. Third one is a commission. Commission is the expenses of the business, and it is given to the consignee for his service to the consignment business. There are popular two types of commission. One is a general commission. The general commission is calculated on some of the percentage of total sales, while there is a del credit commission or a DC commission. If we are going to abbreviate it, the popular name of this commission is a DC commission. On this DC commission, the DC commission is to be calculated on a credit sales. Remember one thing, you are not going to calculate this DC commission on any recommendation sale or recommendation credit sale. Now, what is a recommendation credit sale? Recommendation credit sale is those sales which are made by the consignee with the instruction of the consigner. Fine. Those sales are said to be recommendation credit sales. Now, what is purpose of this DC commission? Understand one thing, this DC commission is given on credit sales. That means if there is any bad debts, it will not be borne by the consigner, because the risk of the bad debts is transferred by consigner to the consignee in form of commission. So consignee will not sell goods on credit without any conscience. He will sell goods to those debtors who have some of the trustworthiness in the market, and for that del credit or a DC commission is given. So if there is any bad debts, it is responsibility of the consignee that he will bear whatever the loss due to bad debts. For those loss, we compensate consignee with DC commission. So here you are going to understand one thing, if DC commission is there is no entry for bad debts, and if there is a no bad DC commission in the sum, you have to given the entry for bad debts. Now next point is for bad debts. Clearly there is two rule. Rule number 1, if DC commission is there is a no entry is given for bad debts. Rule number 2, if DC commission is given and if there is a recommendation sale on credit bad debt entry is given for recommendation sale only. So DC commission is not calculated on recommendation sale, and if there is a bad debts due to recommendation sale with the sale which is happened with the instruction of the consigner, then those bad debts due to recommendation sale must be borne by the consigner even if there is a DC commission. Fine. So we are going to understand these points very clearly when we are take any practical sum. Fine. So these are the important concepts I want to clarify with you before starting any practical sum. In next lecture, I will take one of the university sum to understand the posting of different journal entries of consignment account. Thank you.